welcome to another episode of Finance Footnotes Fast 5. I'm your host, Brent Stransky, and I'm going to give you 5 important market points here in only 5 minutes. Today is Friday, September 19th. Let's get started. The first thing I want to talk about is the biggest news point this week is the Federal Reserve cut interest rates for the first time in over 9 months. This was a heavily politicized event. Everyone was watching what was happening. And this was, of course, after last year, the Federal Reserve made two 50 basis point cuts just before the election, which President Trump and his allies made the assumption that was a politically motivated event. And of course, since then, have not made any cuts. So right now, the current Federal Reserve interest rate has been cut, and the new rate is between 4 and 4.25%. And as a reminder, when the government reduces rates, it's stimulating the economy, okay? So the chart I have on the screen there shows you Federal Reserve interest rates over the last 25 years. But I also want to highlight what is called the Federal Reserve Governor's dot plot. It's a little statistical jargon here, but it is indicating that the Federal Reserve governors are expecting, on average, 2 more quarter point cuts this year and at least 1 next year. So just for comparison's sake of other central banks across the world, the Canadian Central Bank is currently at 2.5%, and the ECB, the European Central Bank, is at 2%. And with our rate currently at 4 to 4.25%, you can see there's a big discrepancy there. Why did rates take so long to come down? Well, the Federal Reserve Chair, for a good reason, is concerned about inflation rates. And I just want to highlight 2 important things here. Inflation last week for the month of August, and it came in about as expected, up 2.9% year over year and up 0.3% in the month of August. Inflation has generally been coming down, as the charts on the left there show, but there's also been a lot of information out there in articles about how the government data has decreased in value. Fewer households are responding to government surveys, so the data just isn't as good. So using technology, we've talked about before, Trueflation measures over 15 million real-time data points of the economy, things that are being sold and what they're being sold for, and it measures the current price of inflation at 2%. So there's a big discrepancy there. That 2% is the exact target of what the Federal Reserve is looking for. So inflation is managed, and that's what gave the Federal Reserve the potential to cut interest rates there. Second thing I want to highlight about the Federal Reserve policy, they worry about inflation as well as jobs in the economy, full employment they call it. So a couple of things happened last week. The jobs numbers for August came in, but also the unemployment weekly claim, first time claims on unemployment was much higher. It was the highest all year. You see a chart there showing you what has happened there in the past couple of weeks there. But you can see that it is meaningfully higher. That could be concern that the economy here, the jobs market, is decreasing a little bit. But the jobs number came in August, reported up only 22,000. That's much less than expected, and it's just showing that perhaps the jobs market is cooling off. That's definitely, a primary driver of the economy. Are we in a good economy? Well, if you have a job, maybe you feel like we are. If you don't, the opposite is true. So that's the third point I wanted to highlight there for you. Fourth point, markets have been doing very well so far this year. There's a huge decrease in April based on the tariff concerns, as you remember, but things have really zoomed up since then. And I was reading this week in the Wall Street Journal from James McIntosh. He's kind of like a perma bear. He's very pessimistic, always highlighting concerns in the marketplace. And I have here on the screen here a quote from his article, which was just a couple of days ago. And it says, everyone agrees that those stocks, which are the tech stocks, are phenomenal and bound to go up. In other words, everyone agrees stocks are bound to go up. And that really caught me off guard because I don't think that's the case. And turning to data from the American Association of Individual Investors, you can see here kind of a busy chart, but I just want to highlight a couple of things. One, everyone's not optimistic about the stock market. In fact, the opposite is true. So this is data as of last week. Only 28% of respondents were bullish in this survey, and that's compared to about 38% on average. And about 48%, almost half, 49.5% are bearish. That means they think stocks are going to go down in the next 6 months, and that's significantly more than the 31% that is the average. This is, the Wall Street Journal talking heads say one thing, everyone thinks markets can go up, but in fact, people are anticipating some volatility going forward. Just as a reminder, this is the contrary indicator. Typically, this is what we want to see. In fact, if you look here, the most pessimistic was in early April. Just as the market was crashing, that would have been the best time to buy stock. So as usual, I want to leave you with point number 5, just a couple optimistic takes here as we go forward. The first chart I have for you is just showing you the Federal Reserve cut rates. We talked about that as point number 1, but they did it as markets are within 2% of all-time highs. In fact, markets made all-time new highs just the day before. This has happened 22 previous times in the last 75 years. Every single time, 22 for 22, the S&P 500 stock market index was higher 12 months later with a median return of 9.8%. The reason is interest rates go down, it's stimulating the economy. It's typically good for stocks. And it has been the case 22 for 22 times. That's a pretty good sample size. And then turning to something else, this is just a measure of momentum. Things have looked really good over the last 5 months. Since April, stocks are up 30%. That's a very strong accelerated increase in a short period of time. It's only happened 5 previous times, going back to 1950. So in 75 years, and this is only the 6th time, so a very small sample size, but 5 for 5 of those times, the S&P 500 was higher 12 months later with a median return of 13.9%. So 2 optimistic reasons there: momentum, accommodated Federal Reserve Bank. So I think markets can continue higher. If you have any questions, please, as always, let us know.